if you don't, if you're more of a personal lines heavy agency
Yeah,
and you've dabbled in small commercial or commercial lines, but you really haven't done it, again, that area of the market has its challenges. There are certain pockets that are challenged, but there's still more smooth sailing, right, on the commercial line side, and you
for
can
sure.
target. But I want to come back. So the balance is really important,
Mhm.
right? As you kind of build an independent agency, you want to maintain balance, because
Mhm.
when a certain segment of the market goes hard and it's really tough, ultimately rates are gonna go up and your premiums are gonna grow. You may not grow your customer count, but your actual premium will grow. Um,
Right.
this is something that
That's interesting.
this is something that's going to happen. So two quick things. When you were talking about that, as far as like talking to the customer with the rate increase, and how do you prepare your staff and whatever. So again, this is California specific, and this is just, I may be wrong, totally 100% wrong, but what I firmly believe is that in the next 24 to 36 months,
Mhm.
we're going to see 20 to 30% cumulative rate.
Yeah.
So right now, and I was having this discussion with one of our family friends who has a young driver, right? Like I
Mhm.
have a young driver coming up soon, which I'm looking forward to it, but I'm not for
Sure,
insurance, right?
sure.
But I was telling her, I'm like, hey, I said, I'm like, I gave her the pizza analogy,
Yeah,
right? And I said, can you believe this? I said, but here's the thing, we're still paying 2020 rates.
right.
We haven't even felt the pain yet for auto insurance.
Yeah, oh my
And so I was
gosh.
telling her, I'm like, hey, I got a young driver coming. You have a brand new young driver. I'm like, in the
Lock them in.
next 2 to 3 years, like we're going to be paying more.
Yeah,
And so
for sure.
I think that what's important, again, if you come back to the premise that insurance, none of us really want to care about our insurance until we have to.
Yep.
Once it's resolved, we're happy, we're good. But until it comes back on our radar and we have to care about it. But when you're having those discussions, really and truly, I think as an industry, we need to be telling the clients the next 2 or 3 years,
Mhm.
expect higher rate increases because of all the stuff that's happened with inflation and everything else. But we haven't been able to take rate increases for the claims trends,
Sure.
right? We haven't been able to keep it even. Um, and kind of just one other quick little thing.
Mhm.
One game that I've played with some of our family friends when we're talking about insurance is like, hey, Chris,
Mhm.
like, how about you and I start an insurance company today?
Yeah,
Except the only rule is we got to like charge rates from 2020.
right.
Do you and I want to take our $10 million or $100 million if we had it and
Mhm.
be like, yeah, that's something I want to do? No, the answer is actually no, maybe hell no. Um, and so when you say that to a customer and you say, look, this is kind of like we need rates, but we're way behind. And you and I can look back the last 2 years and be like, hey, this is what happened with the cost of going to Chick-fil-A. This is what happened to my gas. This is what happened to I go get my car fixed and it takes 3 months, like there's no
Yeah,
computer chips, whatever. But these are basic things that we as agents don't actually do a little quick scenario with the customer if they want
yeah,
to take the time to care. A lot of people are just like, I don't freaking care. I don't just get off the phone with me, huh? But if you do
yep.
have a client who's willing to listen for 30 seconds,
Mhm.
you can convey a little bit of the challenges in very simple ways.
Right.
Anyway,
I love the analogy too, Tony, because like it's been happening with me with customers, and I've been having to kind of explain these situations several times now. Um and just to keep it super simple, it's just, the companies are, they're paying out more claims than they've received premiums. So, and that happened because of the carryover mainly because of COVID, and the slowdown of, the money that they received, and now their claims are way up here and the money's down here. So yeah, if you can somehow formulate that into even like I love the analogy, because that even maybe is something I'll think about. I don't know if the pizza one, I'll steal it
Pizza.
from you, but yeah.
Well, so I'm going to give credit to Rich, one of our members who was in the restaurant business, and
Oh,
I
gotcha.
we spent about 30 minutes talking about a little deeper level on the mechanics, similar to what we're talking about here, but a little more technical.
Mhm.
And he's like, at the end of it, he's like, well, it sounds to me like I'm selling $12 pizza. It cost me $4 for the cheese. Now it's 18, but I got to sell it $12. I'm like, yeah. And then I took it all the step further of saying the front door, the phone, you're not going to answer the phone.
Right.
But I do think, Chris, like
Mhm.
one of the when it comes to dealing with the customers, if they can understand, we can sit here and talk about supply chain and labor and inflation and used cars and all this crap.
Mhm.
At the end of it, really, I mean, other than some simple analogies, telling a client, look, COVID was a black swan.
Yeah.
And if you think about, again, I'm going to use California because annual mileage, and we'll just spend 30 seconds on this.
Mhm.
In most other states, guys, this does not matter to you, okay? Because the annual mileage that a vehicle is driven is not a major rating factor for most states. In California, it's the second most important rating factor.
Really? I didn't know.
Yeah.
I thought that was across the board for the most part.
No, because in other states they use credit
Ah,
scoring,
that's
right?
right. That's
So
right.
so like if you're in different states, and I've never written in other states, so I don't like
Yeah.
technically know how they re-tier people based on renewals and their credit score and all that stuff.
Yeah.
But in California, it's your trying to remember, it's either your year's licensed, I think it's your year's licensed, it's annual mileage, and it's your driving record.
Driving record. Yeah.
Those are the top three.
Right.
Okay?
That makes
And
sense.
so when you were what made me want to bring this up is that when you think about like driving less, but premiums went down, but then the costs went up, the claims went up, that's
Mhm.
exactly right. Because if you in your mind,
Mm.
if you picture like insurance as like a kind of a steady chart that just kind of in trend kind of goes slow and up to the right, insurance premiums just kind of generally slowly rise over time,
Right.
but which is kind of generally how like businesses grow and
Right.
assets expand. It just kind of little by little. But with COVID, if you imagine a chart, which I think I've shared with you guys, like in
I think so.
the auto chart in California, it's like a huge V pattern, right? So
Yeah.
2020 hits, claims dropped like crazy
Mhm.
because nobody was going anywhere. So the insurance companies had to give back money, right? That's fine. It's legit. I mean,
Right.
there was
Right.
less
Right.
exposure.
Rightfully so.
Yeah, yeah. So
Mhm.
less exposure, but the problem comes in the fact that when we reopened back in June of 21 in California, everybody went back to normal life, right? So annual mileage,
Mm.
it's going along, and then drops like a rock, right? Because nobody's
Okay.
driving.
Yep.
Premiums come down, premium refunds come down,
Mhm.
um, claims dropped to the floor. Then we open back up, everybody starts driving again, like bam, and it goes back to pre-pandemic levels. Well, the premiums didn't come back. Not only would not have rate increases,
Right.
like you and I were joking about before we got on, nobody called Tony and said, hey, I'm back to work, I'm driving 14,000 miles a year again, not 4,000 miles. And
Yeah.
so when you think about the magnitude of the impact, if mileage is a really important factor for the rate, when that gets dropped, the premiums drop dramatically. But if
Right.
you don't reflate and re-underwrite or just restate the accurate mileage, what the client is really driving, then what you have is you have maybe premium that drops 20%, 30%, initially rightfully so,
Right.
but then the client starts driving, so the exposure, the risk doesn't come down 20 or 30%, it goes back up because now they're driving 14,000 miles a year, not 4, So they're on the road 3 times more than they were during COVID, except they're paying 20 or 30% less. So again,
And
if you and I were starting an insurance company and
right.
it's rate for the projected future loss, that's what insurance is. I
Mhm.
just want to try to charge a rate that I can make a little profit for what I think might be my future loss.
Yeah.
That's it. It's basic, right? It's very complicated, but that's the basic
Right.
philosophy. So when your premiums have been suppressed, but your exposure's back up,
Mhm.
that's why the freaking loss trends are out of control. Like that's one of the big reasons, and is why like the annual mileage piece is such an important factor. Again,
Mhm.
this impacts other states because if people are driving more, they have a higher chance of getting in a wreck or hitting somebody or doing something. But it's not as important of a rating factor
Right.
in other states. So it's still a relevant measure across all of auto insurance, right?
Yeah.
Anyway, sorry, that was a complete side trail, but it's such an important element that clients don't really think about.
Right.
They just don't think about it.